So let's look at the component of trade cost measurement. Imagine there is stock XYZ whose opening price is currently $10, and I made a decision to buy stock XYZ maybe 1 hour after the market opened when the price is at $12, and I want to buy 10,000 units of stock XYZ. Because I made the decision to buy this stock at this price, we call it decision price. Don't forget the meaning of decision price. Decision price is the securities price at which the manager made the investment decision to buy or sell. But here, my intention is to buy. Imagine this stock was not sent to the execution broker until the price is $13. And it was actually executed when the price is $15. Please don't forget the meaning of arrival price. Arrival price is the price of the security when the order was sent to the market. So you can see that from the time I made the decision and when it was actually sent out, there is a delay, and that's what we call the delay cost. The distance between arrival price and execution price, that is the trading cost. The trading cost could also be known as arrival cost. Let's also imagine that the execution broker executed 8,000 out of the 10,000 shares that I sent out originally when the price was $12. And the closing price for this stock XYZ is, let's say, $18. If I want to calculate the delay cost will be the distance between the arrival price and the decision price, which is $13 minus $12 times the number of shares that were executed. So delay cost will come as a result of executed shares. The same thing for trading cost. It comes as a result of executed shares. So trading cost will be from the execution price to the arrival price, and that's how much? That's $15 minus $13 times the number of shares executed. Then we also have execution cost. Execution cost is just the addition of the delay cost plus the trading cost. Or I can just easily say that is the distance between execution price to decision price. That's this here, and that will be $15 minus $12 times the number of shares executed. So you can already see that delay cost, trading cost, and execution cost, they all will go to with the number of shares executed. You must execute shares for you to be talking about delay cost, for you to be talking about trading cost, or for you to be talking about the addition of both delay cost and trading cost, which is execution costs. So now let's move to opportunity cost. Opportunity cost here is against what was not executed, and our opportunity cost is the distance between our closing price and the decision price. Closing price is $18 minus $12 times the number of shares unexecuted, which is 2,000. Don't forget, out of the 8,000, so I executed 8,000 out of the 10,000 shares, 2,000 were not executed. It's also very important to note that for buy order, which was what I did here, the number of shares will be positive. So this 8,000 will have positive sign in front of it. All of the number of shares will be positive. But if I was talking about sell order, all of this number of shares would be negative. Please let's note that. So the difference between buy order and sell order is just for you to adjust accordingly for the number of shares. The stock price would not be adjusted for. Opportunity cost. Opportunity cost, just like we said, is the unexecuted shares of the order. So from the example I gave earlier, it is 2,000 that is unexecuted shares. Insufficient market liquidity can result in missed trading opportunities, and it will generate opportunity cost for the fund. So what does this mean? If the market is illiquid and you know it is illiquid, why did you send out up to 10,000 shares to be executed? You should have reduced it. Sending it out, sending this high number of shares obviously will lead to generating opportunity cost for the fund, and there will be missed trading opportunities. So the opportunity cost component of the formula provide an understanding of the potential profit that the investment manager's investment idea missed out on. So moving on, execution cost, I'm sure we should be fine with it by now, is against the shares that were transacted in the market. And execution costs occur when buying and selling pressure are on the order, and typically what this means is the fact that you are buying at a higher price and you are selling at a lower price. Everyone always wants to buy at a lower price and sell at a higher price. But if you are doing the opposite, then we would say there is execution cost. From the example I gave, I made the decision at $12, but I actually executed at $15. And the major reason behind this was because of the execution cost in between. The price kept on going up. I wanted to transact at $12. I ended up transacting at $15. So finally, as a result of all I've explained here, the fund experiences increased expenses and reduced realized return, because execution cost would increase the expenses, and if we are talking in terms of realized return, it would lower it. So this is the formula. The only addition that we'll talk about on the next slide will be fees. And it's worth noting that execution cost plus opportunity cost plus the fees will give us implementation shortfall.